Mohnish, welcome back. Round two.
Shaan, it's always a pleasure.
All right. I want to start with something that I was reading in your book, and it kind of smacked me in the face. And it said, in investing, the small guy has the advantage. And I love that because in everything else in life, it feels like the big guy always has the advantage. So why does the small guy have an advantage in investing?
Yeah, so if you think about it, if a small guy is an exceptional investor, right? And picking through these, weird anomalies and, arbitrage and other opportunities that are really tiny, right? They would compound capital at a very high rate.
Right.
And very soon they couldn't play in that arena because that arena can maybe take 100,000 of capital or 1 million of capital.
Right.
So once they get past the 100,000 or past 1 million or past 5 million, they have to seek out larger pastures. And they have to move up because if you have 100 million of capital, you can't put it out 10,000 at a time.
Right.
Okay, that's not going to work. But if you had 100,000, you could put out 10,000 at a time. So when they go from 100,000 to 1 million to 5 or 10 million, they have to leave the small space.
Right.
And so the small space now becomes open for the next generation. And the best of the next generation come in and again, kind of, hit it out of the park, and then they leave it for the next generation.
Right.
So the very tiny opportunities are always a fertile hunting ground. Buffett says that if he was running $1 million or $10 million, he would do 50% a year.
50, yeah.
But
and he did, right, at the beginning?
Oh yeah, he was killing it. But when you start getting, even from 1 million to 10 million, it changes a lot. And from 10 million to 100 million, it changes even more. And when you're looking at sums below 100,000, that's the most orgasmic space to play in, okay? Because there, the entire universe is available to you. And there are many opportunities where the returns are very high, but the amount of capital that can go in is extremely tiny. And those would be the kind of nooks and crevices that the small guy would play in.
Right. So let's play a game. You're my coach. You're my investing coach, let's say. And I have $10,000 and I want to turn it into $1 million, right? Podcast called My First Million. I want to go from 10K to $1 million. So that's 100X or 100 bagger in your terms. What would you be advising me? How would you coach me to think about that? How would I take 10K and turn it into $1 million?
So I would make some tweaks to your thinking first about the 10K. So I would say, okay, the 10K is a good starting point. But what I also want you to do separately from that is have a day job.
Yeah.
Okay. And I want you to spend less than you're earning. And I want you to take the 10K and I also want you to take your annual savings. Maybe that's 5,000-10,000 a year or whatever it is. And normally, I would say put it into an index, right? The index, like the S&P, is overheated. We can't go there right now. Circa 2025, we cannot go into the S&P. Okay, maybe 2035 we can, but not 2025. So what I would do is I would treat Berkshire Hathaway as the index because they have such a huge portion of the market cap in cash, and they're ready to,
right? What makes you say the S&P is overheated?
Well, I think that if you look at the Mag 7 in terms of just trailing PEs and all of that, it's way above the S&P long-term average. But even if you ignore the Mag 7, you look at the 493 other stocks, they are also trading significantly higher than historic averages. So it isn't just that the tech portion or the large techs are, because those are exceptional businesses, they may well continue to do exceptionally even for a while. But the thing is that when the multiples become high, it becomes difficult. You hit a kind of a brick wall. And this isn't the first time. We've seen this story play out. So for example, in the year 2000, early 2000, there were 3 stocks that were over a 600 billion market cap. On the whole planet, there were only 3 stocks over 600 billion. They were Cisco Systems, Microsoft, and GE. And we know how that story ended. Cisco never saw that market cap again from 2000 to 2025. Company's done well, it's grown and all of that, but it was just too euphoric. And Microsoft has also done exceptionally well. But from 2000 to 2015, 15 years, zero returns. And it wasn't just zero returns. It went from a 600 billion market cap to a 200 billion market cap before coming back to 600. So it wasn't a pleasant ride. And if we look at GE, we don't need to talk about that. I mean, that just imploded. It never came back. So in general, investing in the largest market caps in a time of euphoria isn't a great recipe for success. Okay, I wouldn't want
There's no book on the wall that says
I wouldn't want to be all in on the Mag 7 and say that's where I'm going to be. I think that may be pushing it. But I would say that compared to even the remaining 493, I would take Berkshire over the 493 in the S&P. So I would just say the default currently is you put it dollar cost average into Berkshire Class B shares, right? And you keep doing that day in, day out. Now, the thing about investing is that opportunities are not going to show up just because you have the cash. Okay? There is a mismatch between when you're ready to make an investment versus when the opportunity is there.
Right.
So our plan A is just keep putting money into Berkshire. And if we did that, the math is really simple. Even if we were doing 10% a year, right? I mean, which I think is pretty reasonable for Berkshire. Rule of 72, we would double every 7 years. Life is all about doubles. Okay? So now, if we are doubling every year and we went, let's say we are a 20-something guy with 10,000 and you go for 50 years or 49 years, it's 7 doubles. Okay? 7 doubles is 128. Okay? It's 128 times your money. I gave you more than 100x.
Right.
I gave you 128x in 49 years.
Without having to be a genius.
Without doing anything, right? So this is just plan B.
Right.
Where we put the 10,000 in, it becomes more than a million, 1.33 million with no taxes paid.
Right.
There's no dividend, there's no taxes, there's nothing. And we haven't even gone to plan A yet, right? This is just sitting there. Now, the other thing is that every once in a while, there'll be opportunities that show up. And what we're looking for is something that hits you in the head with like a 2x4. So the best investments are ones that make no sense. You cannot make sense of the numbers. It's too good to be true. It's just weird and all of those things. So when these kind of unusual things come together where things don't make sense,
right,
that's when we want to dive in.
Give me an example, either from a simple example, either from your own investing, a Buffett investment, some case study of an example of a great investment is one that doesn't make any sense. The numbers just seem wrong, and to you in the moment.
I'll give you one example where it was a moneymaker for me, but I didn't make even 3% of the money I should have.
Okay.
It was given to me on a platter and I blew it. I still made money,
right?
But I want to explain how, usually the best ideas, when you finally figure them out, they're very simple. In the year, I think this was like around 2001 or 2002, I had encountered this shipping company called Frontline. And Frontline was a company that owned a fleet of about 75 VLCCs, very large crude carriers. These are giant ships that transport crude from like Saudi Arabia to the US, and they're just huge. The entire global fleet at that time was 300 ships, 300 VLCCs. 75 of them were owned by Frontline, 25% of the market. The guy who ran and was the founder of Frontline, John Fredrickson, had put the entire fleet on the spot market. So there are two ways he could have dealt with his fleet. He could have done time charters, kind of 1 year, 3 year deals where he's guaranteed cash flows per day and all that, or be a gambler, put it on the spot market and play it.
Whatever the price today is,
right?
I'll take it.
So he had put it on the spot market, the entire fleet. Now, these VLCCs, they have a cost with the cruise and all of that of around $15,000 per day to break even. That's the cost to break even. And at that time, we had like the Iraq war and different things going on. So oil demand fell a lot. And there wasn't enough need for VLCCs. So the shipping rates collapsed to the point they went to $7,000 per day. Okay, so now you have Frontline losing 8,000 per day times 75 ships.
Right.
Okay. And they're levered. Okay. And so basically the stock got taken out back and shot. Okay. Like a 90% drop. Okay. And most of it was valid because basically, when we are making investments or when equity markets look at a company, they want to see consistency of cash flows. They reward consistency of cash flows. Here, what we were seeing is consistency of losses. Okay. No one could tell you when these losses will abate. So the dynamics were the stock, I think, was down to like $3 per share. And when I looked at it, I noticed two things. Okay, the first thing I noticed is all their debt was non-recourse. Their debt was tied to individual ships. There was no debt at the parent. So basically, if they defaulted on the debt of a ship, the bank could just take the ship. They couldn't really take the company, could just take that ship. They take a car loan. And the second thing I noticed was that there's a very somewhat liquid market to buy and sell these ships. So even when the rates went to 7,000 per day, the ships had dropped in price by something like maybe a third, 25, 30% drop from where they used to be.
Right.
So what I realized is that if Frontline got into a crunch where they were having cash problems, they could just sell 3 ships. If they sold 3 ships, paid off the debt, they'd have enough cash left over to keep sustaining operations for 6 to 9 months. They could sell 3 more ships after that. So I felt like there was really no way the company was a candidate for bankruptcy. And there was really no way. And the other thing is I could look at the entire company and say, okay, what if they sold all the ships? If they sold all the ships, paid off all the debt, you would end up with like $9 or $10 a share. You're at $3. So you make 3 times your money if they just liquidated the whole business, right? So there was the arbitrage between the price of the stock and the net price of the assets in a distress scenario, right? So I said, okay, we really can't lose money here. And we're going to go buy Frontline. So I put 10% of my fund into Frontline, right? Because I just couldn't see a way that we could lose money. Now, when these rates were at 7,000, what happens is scrapping of ships skyrockets. So there are these Greek ship owners who have like 1 or 2 VLCCs. They're like 25, 30-year-old rust buckets. Yeah. So they send them to Bangladesh or India to be broken up, sold for scrap, get 10, 15 million out and go do something else with the money, right? Because the old ships stop getting rented because they're single hull. Right. After Exxon Valdez, everyone wants double hull ships. So when the market basically goes weak, everyone wants to rent the double hull ship because the prices are about the same. Right. So all the single hull ships are getting scrapped. So now the fleet went from 300 ships to about 250 ships. After a few months, the rates start improving. The oil demand starts coming back up. The rates go to 15,000. Then they go to 20,000. The stock's at $10. Okay. I sell my shares. Well done, Mohnish. Okay.
Tripled my money.
Yeah. In like 8 months or something. Okay. And I said, okay, this was exactly what I thought, right? Rates then go to 300,000 a day. Okay. At 300,000 a day, they're making something like 285,000 a day times 75 ships. Okay. That number is like infinity. Okay.
Yeah, I was trying to do the math.
Just assume it's infinity. The stock goes up in the next 3 years, 80x.
Oh, wow.
Okay. Here's stupid Mohnish, okay, patting himself on the back with the double. And I didn't even get a double. I got like 80% return on my money, and that was that. And so that was an example of where I did first order thinking, but I did not do second order thinking. So the second order thinking was, Buffett always says that the most important question to ask in investing is, and then what? Whatever you think, then you say, and then what? And you keep asking that, and then what? If I had been so smart as to ask the question, and then what? So you see that rates are terrible. You see the scrapping. You see that fleet's going to shrink. So even if oil demand doesn't come back the way it was, it's going to come into balance. eventually those losses are going to go away. And then you do the next thing on 10 watt, which is that when oil demand comes back, it takes 3 to 4 years to build one of these things. So when the rates went to 30,000 or 50,000, and all these guys can see this is a great business now. Well, when you go to the Korean shipyards, who are now inundated with orders, they're going to say, go to the back of the queue. I'll give you a ship in 5 years. And by the way, the ship is no longer 70 million. The new price is 120.
Right.
Okay. Because I got more orders than I can handle. Right. So we had this dynamic, if I had thought about it, that once the demand became tight, you really couldn't increase supply for at least 3 or 4 years. So what's 285,000 times 75 times 1,000 days? That's the minimum number of time when that price is not going to come down. It's only after 3 or 4 years, more ships start getting delivered and you start getting more balance and all of that. But that's an insane amount of cash flow, right? So the thing is that there are always, like, our friend Jim Cramer says, there's always a bull market somewhere. Okay. So basically, if we are plan A, Berkshire Hathaway, plan B, looking for anomalies, right? Every so often, not very often, every so often, you will find something weird. And we've got all the time in the world. We can research something for 3 months. It turns out it's not that great. Let it go.
Right.
We got Berkshire still cranking. Okay. So if you look at Warren Buffett, in his 2022 letter, he said that in 58 years of running Berkshire, there have been 12 decisions that have moved the needle for Berkshire stock. Now, in 58 years, he made more than 300 or 400 purchase decisions for stocks and businesses. Okay. Out of 300, if I take a conservative number, it's actually more than that, only 12 were exceptional. And he said there was one good idea on average every 5 years. Okay. This is Warren Buffett.
Right.
With a 4% hit rate. Okay. So basically, great investment ideas are rare. We're not going to run into them every week or every month or every year. So plan A, stick it in the index. Plan B, keep running a Geiger counter over everything, looking at different things. And when something doesn't make sense, drill down. And every so often, you're going to hit a mother lode.
Right.
And when you find something that's a mother lode, you peel off 10, 15% of what you have in Berkshire, put it into that, let it play out, then put it back into Berkshire.
Right.
Right. And just you keep doing that. And now your 100x is going to show up in half the time or less.
I like that story. And I like, I've heard all these examples of whether it's Buffett, Munger, it's your investments that you've made that are really interesting. But what I don't know is the process. So you tell me the story about these ships. And when you explain it, I can see it just like you see it. Oh, that's the opportunity. But the thing I don't get is, why are you looking at crude oil ships? How do I get to how do I even know where to look? And so what is that process for you? Do you pick one industry and look at 100 companies in it? Do you read books on 50 industries? Do you look at what other investors are doing and try to reverse engineer? Where do you even know where to look?
I'm going to lay it out for you. It's going to be so easy, but it takes a certain temperament.
Okay.
So first I want to talk about the temperament. Okay. So if we go back to Warren Buffett, when he was a teenager, he used to go to the racetrack in Omaha, Aksarban. I don't know whether we talked about it last time or not.
A little bit, yeah.
Okay.
You can tell it.
But he used to go to the racetrack. And one of the things he did at the racetrack, he was like 14 years old or something, is after all the races had been done, he'd pick up all the tickets that people had left thrown on the ground, right? These are mostly losing tickets, right? They just kind of toss them from the garbage cans. He'd pull them all out. Then he'd go home and one by one look at every ticket. He would find, now sometimes a horse would come in second and the ticket was for win or place. It was actually a winning ticket, but they didn't understand, they were drunk or whatever. Right. So he'd always find a bunch of tickets which were actually in the money, but they'd been discarded. So now he was underage, he couldn't go to the counter to collect the money. So he gave it all to his Aunt Alice, his favorite aunt. She used to go to the counter, collect the money and give it to him. Okay. So when Warren became older, let's say when he was, let's say 24 or 25 years old, he went through the Moody's manual. And what he was doing at the Moody's manual, and for nostalgia, I bought these on eBay. And when we take a break, maybe I'll bring one of these.
Yeah.
I want you to see the Moody's manual, okay?
Yeah. Do you have it right here?
Yeah, they're right here.
Let's grab it. While you tell the story.
Buffett was 23 years old when he...
This was his nighttime casual reading?
This was his... So what he did now with the Moody's manual, there were a number of these that came out. So like in the year 1953, this is just railroads, airlines, shipping, traction, bus, and truck line.
I don't even know what this is. Is this the earnings reports of
So this
all
is
of
the value
companies?
line of that day.
Okay.
Okay, so if I open the Moody's manual to any random page, okay, what it's doing is it's got like 2 or 3 companies per page. You can see how fine the print is.
Yeah.
Okay. All right.
You need like a magnifying glass.
And so it's basically giving you a summary of every company, right? Now, this is just one of them in 1953. For 1953, there were probably about 7 or 8 of these books that came out in 53. Similar number in 54, 55, so on. So you're talking about a big stack of these, right? He went through these books 2 or 3 times. He went through, what he did is he read each one page by page, right? And he was looking for anomalies. So he used to host these MBA students, and actually he brought for them printouts from the Moody's manual to the ones that he made an investment in. So he would find something like Western Insurance, for example, where the stock price was 15 and the earnings last year were 25. Okay, the stock is $15 a share. Earnings are $25 a share. Book value is $80 a share. Okay, that's what we call an anomaly, right? Hitting you by a head with a 2x4. Makes no sense. He would make a list of all these companies which made no sense in the positive direction.
Right.
Okay, and then he'd study them, right? And then he would make investments, right? Now, in order for Warren to find Western Insurance, he might have had to spend 14 hours a day, okay, non-stop reading these for 3 months before he finds 1 or 2 of them. But he only needs very few of them. And Warren's mind, he's a prodigy. So his mind was programmed to have this intense, the work never bothered him. Just like no other teenagers were going and collecting all those tickets on the floor and then going through each one with the optimism that I am going to find something that is basically a free lunch, right? And so he went through the Moody's manual and basically started finding these anomalies and then started making investments in them and did well, etc. Now, we have a shortcut, because I know that your listeners are not going to do what Buffett did, okay? I cannot do what Buffett did. I mean, even though I like what he does and I want to do what he does, I do not have the wherewithal and the ferocious intensity that Warren does. Almost no one does. I think that he's just an extreme anomaly on that front. So, for example, there's a website called Value Investors Club. Okay. Now, if you go to Value Investors Club, it's free. You don't have to pay anything, whatever. If you give them your email, you can see all ideas that are 60 days or older. Okay. And if you don't give them your email, you can see all ideas that are 120 days and older. It actually doesn't matter because there's ideas on Value Investors Clubs that are 10 years old, 15 years old. It's very difficult to become a member of Value Investors Club posting ideas. So it's like a curated website.
Right. Okay.
The members have to submit 2 ideas a year, which get a decent rating in order to keep their membership. So what I have found is the Value Investors Club has a lot of brain power. It has brain power coming out of their ears. Okay, it's all free. So all someone has to do is sit down and read the write-ups on Value Investors Club. So there may be, 600 or 700, 800 write-ups, maybe 500 write-ups in a year. Each write-up may be around 10, 15 pages max. Then there's comments and whatever. But what I'm saying is that it's much easier than the Moody's manual,
Right.
because someone is actually digesting the information for you. So like a Frontline, they would actually just, what I just explained would just be
somebody wrote
explained
that up, right?
would explain it in like 3.
You could do one of those a day.
You could easily do one. Well, one of those a day is pathetic.
I'm saying even you said if there's 300 total.
Yeah, but I'm just saying
less than a year.
It would be easy for someone without putting too much work into it to read 4 or 5 ideas a day. I mean, they could have a full-time job and easily do that. That's not a difficult thing to do. And you don't need to read the whole idea. What I would say is you read the first few paragraphs and see if this is something that's interesting you or not, or something that's grabbing you or not. Right? What I do is I look at every idea that's posted, right? And I don't care to really look at them right when they're posted, because those ideas will work even 5 years from now. Like recently, I started investing in a company where the original write-up was in 2021. Okay? It's 2025. Still valid. Okay? And there's a lot of history of comments and all of that. And I can look at what happened to the business last few years and all of that. So what I'm saying is that the Value Investors Club is a way to basically, it's a very good shortcut. Now, what you still have to do is you should use it only as an input to ideas, just like the Moody's manual is not telling you what to buy and sell.
Right.
Once you see the idea, you do all your own work, do your research, do everything. Make sure it's something you understand well. Make sure it's within your circle of competence, whether you buy into the idea or not, etc. And there's a wide range of businesses. Sometimes the same business, because Value Investors Club has now been around for more than 2.5 decades. So sometimes the same idea has been written up 7, 8 times. So you can go and look at all of them, right? It shows you the whole history of what's been happening with that business. And so I think that if someone is a student and wants to be like Buffett was in the Exarban racetrack, the Value Investors Club is a great tool. And Buffett is still doing this. So his Japanese bets. So there's another book called the Japan Company Handbook. And I'm going to bring the Japan Company Handbook.
Okay. Sounds good. All right, here we have it. And I'm excited about this because you hear a lot about Buffett's, See's Candy, Coke, Geico, like those kind of well-known Buffett's best bets. Yeah. But as I understand it, Buffett made some incredible investments in Japan.
Well, the most recent letter he wrote, there was more than a page on Japan. Okay. So now this book, the Japan Company Handbook, the good news is it's in English. Okay. And it's like the Moody's manual, except that it's basically like, if you look at it here, it's 2 companies to a page, right? So there's like 4 companies on 2 pages. And the other thing is that it updates every quarter. So they actually publish this every quarter. It's on the Amazon website. Okay, very simple. So you can go on the Amazon website or the Amazon Japan website and just place an order and they'll send it to you. So unlike Moody's, which is no longer published, this is something you can buy anytime you want. And again, you don't need it every quarter. You could buy one of these maybe every 5 years or something. So again, what Buffett did with this is exactly what he did with Exarban. He just flipped through page after page. Now, I think it was like maybe 12 or 13 years ago, Guy Spear and I were visiting Warren Buffett in his office. And actually, we weren't visiting Buffett. We were there to have lunch with his assistant.
Right.
So what had happened is that Guy and I got to know his assistant, Debbie, really well when we were setting up the lunch with Warren Buffett, right?
I have this picture of, so there's a picture of you with Warren, which somebody gave
Yeah,
me
that's
here.
right, sure.
But then there's you with this woman, and I was like, "Who's this woman that he's taking a photo
that's
with?"
Debbie. There you go.
This is Debbie?
That's Debbie, yeah.
So
Debbie's awesome.
How did you get to know Debbie?
So anyway,
Why?
so Debbie's awesome, right? So now I told Debbie, listen, it would really be great if Guy and I could take you for lunch. Okay. So she said, look, when you come to the Berkshire meeting, Fridays are crazy in the office. All these celebrities coming in, and all Jamie Dimon's there, everyone's there, right? Yeah. So she said, I can't leave the office on Friday. But she said that if you come on Thursday, I can go to lunch with you guys on Thursday. I said, we got nothing to do.
Yeah.
We can be there on Thursday, no problem. So we started going to Omaha. So we'd get there Wednesday night, and then Thursday we'd meet Debbie for lunch, right? And this went on for several years. And what I realized after a few of these was lunch with Debbie turned out to be better than lunch with Warren. Okay. Because I would tell Debbie, I said, Debbie, between us girls, can we talk? She'd say, what do you want to know, Mohnish? Ask me anything. Okay, so I would get the most, peculiar habits that Warren had, like how does he go through his mail and how does he do this and how does he do his email, all these different things. And, she'd lay it down for me exactly kind of how he did things. So one year we were going to have lunch with Debbie and we go to Omaha, go to the Berkshire headquarters on Thursday. And when Guy and I get off the elevator on the 14th floor, Warren is standing there. So I thought maybe he's there to he's going out somewhere, taking the elevator, but he had come to meet us. So, think about a Fortune 10 CEO coming out to the elevator to meet a couple of yo-yos he doesn't even have an appointment with. Okay. So he tells me, oh, would you guys like a tour of Berkshire headquarters? So we're kind of surprised. We said, Warren, if you want to waste your time giving us a tour, we're all in. Okay. So he takes us around, shows us his Coke fountain and all the different stocks on the board and a lot of paraphernalia there that he's going through, explaining a lot of history and whatever. Then he takes us into his private office, right? And I see the Japan Company Handbook. I see this book on his desk. And I knew before I went there that Warren was actually into the Japan Company Handbook, right? And I had actually just gone through it. So I said, oh, Warren, I've been going through this as well. And I said, can I just mark some of the ones that I think you can just go straight to?
Okay.
Instead of flipping every page. So, he's very skeptical of the whole thing. He said, go ahead, Mohnish, do whatever you want, right? So I took his copy of the handbook and I'm dog-earing the pages that I thought he should look at, right? So I told him, Warren, it just turns out that most of the good stuff is at the back. He said, that's always the case. All the good stuff's always in the back. Okay. So we went through that and I marked the Japan Company Handbook. And so when Warren made these investments, I think he started buying it in 2019, I believe, around then, when he was starting to buy the 5 Japanese trading companies, right?
And do you know why he did that? Is he normally just looking at different countries?
Well, he found them in here. And the reason he did that, so just let me explain how the total no-brainer nature of that bet.
Right.
Okay. So these 5 Japanese trading companies had 8% dividend yield. Okay, so they were paying a 8% dividend. It was very cheap. The index has not gone anywhere for 30 years. And Warren actually got a insane return on these. So what he did is he borrowed the entire amount in yen at 0.5% a year.
And it was not a small amount. It was 5 billion.
Yeah. He put 5 billion, but he borrowed the 5 billion at 0.5%.
The whole thing.
In yen.
Yeah.
In Japan, right? So now he's bought Japanese company paying dividends in yen, which he's bought in yen, right? The dividend coverage is 16 times his interest payment. Okay. So he put no equity, right? And he's instantly making 7.5% on 5 billion, which is about 350, 400 million out of nothing, right? It's just coming to him. Now what happens is, because these companies are so cheap, in about 3 or 4 years, they all doubled in price, right? So now the 5 billion has become 10 billion. Okay. The equity that went in is nothing. So it's infinite return. They all raise the dividend. The dividend based on the original purchase price is about 15%. Okay. And then after that, what he did is he increased the bet. So he was under 5% of all of them. He's now approaching 10% on all of them. And he met the companies and he said, look, I'm obviously not an activist or going to take over the business or any of that. Are you okay if I buy more? They said, it would be an honor to have you as an investor, right? I mean, he flew to Japan, to Tokyo with Greg Abel, and he's in some penthouse suite in some hotel in Tokyo, and he's very old, past 90. So they came to see him in his room, right? They came one by one, and he met all 5 companies, and then he flew back. So what I'm saying is that bet is the same as the Exarban bet. It's the same as those bets with the Moody's manual. And he found it in here.
Core philosophy, right? Your core philosophy is heads I win, tails I don't lose much.
Yeah. And so what I'm saying is anyone could have looked at the Moody's manual, could have looked at the Japan Company Handbook. And if anyone had looked at it and had a couple of viewpoints, he viewed these companies as companies like Berkshire, which they are. These are, Mitsubishi, Marubeni, and all these guys. These have been around for decades. They're very exceptional businesses, great capital allocation, smart people, pro shareholder, all of that, right? And so basically, Warren found Motherlode where he could put 10 billion. This isn't even like something where you could put 10,000 or 100,000. It could accommodate 10 billion at spectacularly high returns, right? And so basically, I think it's a matter of how hungry are you? It's the same as any entrepreneur, right? I mean, basically, anyone who starts a business or whatever, they got to go all in. Intense passion, 18 hours a day, all in, very strong belief. It's the same thing here. If you truly are focused on it, you can do very well. I mean, the universe is going to conspire to help you with whatever your passion is. It's just a matter of whether you want it.
So, one of the things I think is interesting is Munger has this philosophy of inversion, right? So instead of, here's why we should invest in this, you've said before, he was looking for the 60-second answer of why not to invest in a company, right?
Yeah.
And I think that if I take that lens, I say, all right, if I'm here today and I want to be a better investor, I think one of the things, instead of here's all the things I need to do, it's here's all the things I need to don't. What are the things I need to not do? And I think you have a list of some of these. So for example, one of the don'ts is thou shalt not use Excel.
Yes.
This surprised me because I thought, I don't know, it's a lot of modeling and advanced financial analysis, but I think you think it's not that.
Well, let's look at Buffett's Japan investments. He hasn't turned on a computer for investments ever.
Did Debbie tell you that, by the way? Does he use Excel?
Well, he does not use Excel, for sure. Okay. He uses his computer. Now he uses Google and all that, but he uses his computer mainly to play bridge. I mean, Warren wouldn't be caught dead using Excel. Okay. And well, because the thing is that he's looking for things that hit you in the head with a 2x4, right? So when he's going through a Japan company handbook or a Moody's manual, there is no Excel needed. What will Excel help you with when the earnings are $25 a share and the stock is $15? You don't need Excel.
Right.
Okay. When dividend yield is 8% and you're borrowing at 0.5%, you don't need Excel.
Right.
Okay. In fact, if you need Excel, it's an automatic pass because it means that there's something complicated there which is not fitting in. Did I need Excel for Frontline? No, I didn't need Excel for Frontline. I mean, I look up the liquidation price of the ships. I look up where the ships are at. I look at all, I mean, the thing is, all these things are very basic numbers. You don't need Excel for it. And so, recently I was talking to a friend of mine, he's looking at some international stock exchange, okay? This international stock exchange trades at a trailing PE of like 30, okay? It's growing at 15-20% a year, very rapid growth, okay? 60% of revenue is profit, okay? And as they grow, that 60% might become 70% because they got operating leverage. So if you just forward 2 or 3 years, the PE becomes less than 10, okay? There is no need for Excel.
Right.
You can just do it all in your head, okay? It's got $10 of earnings today. It's going to have $12 a year from now, $14, $15 2 years from now, maybe $17 or $18 3 years from now. Stocks at 300. Now when you're at 18, you're already at a 15 multiple, right? You already cut it in half, but it's growing. By that time, it should be trading at even more than 30 times earnings. So the stock may be at 600 or 700 by then. Right? Just the math of all of that. So what I'm saying is that if you can't do the math in your head, it's an automatic pass because that means there's something complicated. So another important thing is you should be able to explain your thesis of a stock in about 4 or 5 sentences to a 10-year-old. Okay. And if you can't do that, it's a pass. You can't sit down with a 10-year-old with an Excel spreadsheet. Okay. They're not going to like you and they're not going to be interested.
Right.
Okay. So basically Einstein used to say there's 4 levels of intelligence: smart, intelligent, genius, simple. Okay. The highest level of intellect is simplicity.
Right.
And so we have to, and the other thing about investing is that you have to have conviction. It's very difficult to have conviction if you keep needing to go back and look at your Excel model.
Right.
You need it in your head. So Buffett never needs to go anywhere. It's in his head. He knows what the dividend yield is. He knows what he paid. He knows what the yen is. He knows all of that. It's pre-programmed. You don't need to think about it.
I have another one. So on the don't pile, so we have don't use Excel. Don't overcomplicate it is really what that means. And the second is leverage. So don't over leverage. And I think the story here that I like is there should be a third bust on this table next to us. Somebody's missing. That was an original partner with them.
Yes.
Can you tell that story? I think his name is Rick.
Yeah, Rick Guerin.
What happened to Rick?
Yeah.
What can we learn from Rick?
Yeah. So actually, Warren, Charlie, and Rick Guerin used to do deals together, and they were all independent doing their thing, but they used to share ideas, and sometimes they'd go in together. So Rick Guerin was based in LA, and he was good friends with Charlie, and we later became good friends with Warren. And they had, for example, I think Rick found blue chip stamps for them. And I think he also might have been the guy See's Candy contacted and so on. So when I met Warren for lunch, and then, after the early 70s, we never heard about Rick. He kind of fell off the radar. So when I met Warren for lunch, I asked him just a very innocent question. I said, Warren, what happened to Rick? There used to be three of you. And then we never heard from him after that. And Warren said that Charlie and I knew that we would get very rich and we were not in a hurry. And he said Rick was in a hurry. So Rick was always using some leverage. And then when the 73, 74 downturn came, that was a very intense, that was a crash in slow motion, basically.
Okay.
Over a 2-year period, the stocks went down like more than 40, 50%. It was a big drawdown. And Rick got margin calls. And Warren said that when he got the margin calls, I bought his Berkshire Hathaway for $40 a share. The stock that's now 700,000, right? So Rick was forced to sell it at a time when it was probably the worst time to sell, right? And so then Warren actually went one step further because he's always trying to add value at these lunches and all that. So he says to me and Guy, he said, if you're even a slightly above average investor and you spend less than you earn and you use no leverage, you cannot help but get rich in a lifetime. So the same thing we went through when we started at 10,000 to $1 million. Okay, we're not using leverage. We don't even need to be above average. Okay, above average in the sense you bought Berkshire. So that's above average. That's good. But you don't need to be a genius, right? And if something shows up on the radar, like the Japanese bets or Frontline or something else, you can make that bet, and that would hopefully help your returns. But if you didn't do any of that,
right,
you would still end up okay. And so what happened later, which was funny, is that in 2009, I became friends with Charlie. And then I started playing bridge with him. And Rick was his bridge partner. And so, I went from I didn't know where Rick was to meeting him every week. And I remember one time, so we used to play bridge at the LA Country Club, which was just, those are some great years. And I remember one time we'd always meet for lunch in their dining room, and all of us would eat lunch, and then we'd go play bridge in their bridge room. So I was sitting, and the other two guys hadn't shown up. I was sitting on a small table for 4, and Charlie and Rick were in front of me. I said, you guys think this is just some lunch, okay? I said, this is an iconic moment. Okay. And these two guys are amused. Some Indian guys, big fan of theirs, whatever. I said, this is such an iconic moment. I really cannot even imagine that this is true. That I have Rick Guerin, who I thought disappeared. And he's such a fantastic guy. And I have Charlie. So I said, you guys did all these deals together. And is there some deal that you did that stands out, something interesting? And I don't know whether we talked about it last time. Did we talk about the nurse?
No, I don't think so.
We may not have talked about the nurse. So anyway, so I said, tell me about some of the good times in the 60s when you were shooting fish in the barrel after the water had been run out. Okay. So they look at each other, and Rick tells Charlie, why don't you tell him about the nurse? Okay. So Charlie says that Rick actually found that there was this business where the owner had died. There was a kind of crazy maverick entrepreneur. And what this guy had done is he had invented additive, kind of a fluid that you could put into your engine in your car, and it would plug any leaks. Okay, so you just put in your engine, whatever, and basically if there was like an oil leak or something, it would just seal it up and it wouldn't really interfere with anything else. And what the guy used to do is he'd go to like auto repair shops with his gun, shoot a hole in his engine in front of them with his gun. Then he'd pour his thing.
Wow.
And that's how he built sales.
What a salesman.
Yeah, he was great.
Incredible.
Crazy maverick, okay? And that's how he built sales, okay? And then he has a heart attack and dies, okay? And the business, this guy was a great inventor, but the business was all upside down with a lever, this and that, a lot of issues. And so Rick told Charlie that we should take control of this company. And he said that if we take control of the debt with the banks, we'll own the business because the equity really is not worth anything. So they bought up all the bank debt at pennies on the dollar. But then there was a twist. So the guy had a mistress, okay? And the mistress was this nurse. And his wife found out that he had a mistress after he passed away because he made the mistress the executor of his will. And the wife was going to inherit the business. But the two women were very upset with each other. And the nurse, as Charlie was describing her to me, she was this blonde, large-breasted woman. And the guy had borrowed, I think, about $80,000 from the wife's aunt in his business. And so what Charlie told the widow is, look, we want to be fair to everyone. We want to pay your aunt the $80,000, full face value of the loan, even though they're buying everything at less. And we'd like to have your blessings to move the business to us so that no one's really upset about it, okay? And the issue was the two women were not interested in doing anything to help the other one. So Charlie decided to meet the nurse at the California Club, which is a very kind of, blue-blooded place. And he'd always go there for lunch. He'd have his table. That's the place where I met Charlie the first time, kind of a lunch club. So he invited the nurse to meet him for lunch so he could kind of basically get a calm down, smooth the feathers, and get the deal done. So she came straight from work. And she came in a nurse's uniform. And her nurse's uniform was about 3 sizes too small. Okay. So when Charlie said when he was having lunch with her, this blonde in this nurse's uniform, the rest of the members in that club thought Charlie's meeting some porn star. Right. Okay. And they couldn't believe Mr. Munger, one of our most distinguished members, is having lunch with a porn star. Okay. And anyway, Charlie said, I was able to smooth things over regardless of what all the members were talking about. We were able to get the deal done. Okay. So anyway, that was one of the funny stories.
Rick and Charlie story.
Yeah. So anyway, but these guys, I think they had just a blast together. But
what ended up happening to Rick? So he didn't get back into Berkshire, or he did later?
He did later. I think Rick was an extremely good investor. And of course, he had suffered a big, kind of drawdown and taking 2 steps back in 73, 74. But I think when he passed away a few years ago, he owned most of the Daily Journal. He had a large stake in the Daily Journal. And I would guess Rick was worth hundreds of millions of dollars. So he done just well.
Yeah.
No problem. He was doing fine.
One of the other don'ts that I like is, I don't know how you say it, but you say like, don't cut your flowers and water your weeds.
Yes.
Which I think is about diversification. And growing up, it's always, diversification is the smart way to invest. So explain.
Well, if we go back to this comment that Buffett made in 2022 in the annual report, that he had one good idea every 5 years, right? Total of 12 ideas in his whole 58 years running Berkshire. The flowers are rare and the weeds are common.
By the way, is he just being self-deprecating, or is that real?
That is real.
Okay.
In the sense that, so he has not had losers. He hasn't had many investments that have gone to zero. There have been a few that have gone to zero. The one that pains him the most is Dexter Shoes. We can talk about that if we get to it. But for the most part, when he's not done well, it's flatlined or done low returns. But these dozen or so positions have really been out of the park.
Okay.
They've been spectacular. So we know that the flowers are rare and the weeds are plentiful. Okay. That's the nature of investing. And so what is very important, which was very important for Berkshire, is not to cut those 12 flowers. This is one of the mistakes I made through most of my career, is I have repeatedly sold good businesses because they appeared expensive. And I was always wrong in how expensive they were. They were actually far less expensive than I thought they were. So it's almost always a mistake to sell a great business just because it looks fully priced or overpriced. So focus more on the quality of the business than the valuation. If you find yourself in a situation where you have ownership of a very good business, leave it alone. Right. Let it do its thing for you.
You last time when we did the episode, my favorite story was the Seinfeld story.
Oh yeah.
And so we actually brought you a little gift.
Oh, that's great.
So this is a portrait of what a great investor looks like.
Oh, that's great. Yeah.
Elaine's boyfriend.
That's beautiful.
you can watch paint dry.
Putty is awesome.
So I got this for your
that's awesome.
for your wall.
Yeah, like they break up at the end of the flight out of nothing.
Exactly. And I think Munger has this great quote where he basically says, like, if you so happen to find yourself in ownership of a wonderful business,
yes,
go find something else to do.
Yes.
Like your job is to stop. Inactivity
yes.
is what gets rewarded.
Yes.
Whereas as an entrepreneur, activity always got rewarded. And I think that's a big mindset shift, I've tried to make as I think about investing versus operating.
Every time I'd meet Charlie for dinner, which was probably every 2-3 months, and I'd play bridge with him, whatever, almost at every single meal, one common area of discussion was Costco. Costco came up at almost every meeting of mine with his, and we would spend at least 30 minutes on some nuance of Costco.
It's like, the meme of guys nowadays, once a week they think of the Roman Empire.
Yeah.
Charlie's Roman Empire was Costco. He's just thinking about Costco
I think he improved his, and I love going to Costco, right? So in fact, my partner and I, we basically have a date night at Costco probably once every 2-3 weeks, right? And basically it's hot dogs with a free drink. That's $1.50 each. And then one slice of pizza. For about $6, we're done. Okay. And we're really happy. And what I notice is, so I'm sitting in the food court with her, right? And I always marvel at this when I'm sitting in the food court. I look at the store where we have the register and we see the whole store behind us. And I especially see all these loaded carts and these very happy people, right? Walking through, getting to the exit, right? And I also see a lot of Indians, right? I see a lot of Indians who have like fully loaded. And the thing what Costco's done is they are selling the Indian yogurt, dahi. Okay. They are selling the Indian clarified butter, ghee. They're selling the basmati rice. I mean, there's so many. I mean, if I were to go to like Edison, New Jersey, Costco, I think it'd be all Indian food, or Indian stuff.
Indian store.
But even in Austin, which is not a like Indian-centric community, they've nailed it. They've nailed it so well. And every time I go there, I marvel at the incredibleness of the moat, where basically they are doing public service. And that's why Costco does so well, is so much of the benefit goes to the members. And that's why Charlie, I think, was always in love with it.
Speaking of kind of Value Investor Club, did you ever see, there's this viral PowerPoint deck called The Resilience of Costco. Did you ever see this going around?
I haven't seen that.
It's one of the best decks I've ever seen. And it's by this guy, he's an anonymous guy, and he just analyzes companies. And he wrote this deck on how, he basically makes this argument. He's like, retail, it has been going down and blah, blah, blah. And Amazon is going this way. But one company has been incredibly resilient. And he goes Costco, and he basically points out, the beauty of the Costco model where they're selling the goods, I think for 10 or 15% above.
Yeah, they have a maximum markup of 15%. And I'll give you one story, for example, that there were these Levi's jeans. Normally they're going for like $30, $40 a piece. And they came across a very large kind of lot that they could buy, tens of thousands of jeans for $9 a piece, right? And so Costco bought the entire lot. And some of the managers were telling the senior management that even at 25, it's a great deal for our if we priced it at 25, they would all fly out. And Jim Senegal told them that it's not going to be priced 15% above what we paid. They priced them at $10. And in 2 days, they were all gone, right? So they left a lot of money on the table. But it's that trust that got built because of actions like that, right? And so people have this incredible loyalty and love for Costco.
And you mentioned the $1.50 hot dog. He's sort of maniacal about not raising the price.
Yeah,
on that. Is that symbolic, or what do you make of that? You know?
Well, so what they've done, if you really study the $1.50 hot dog, is they're backward integrated. So they used to have a vendor, they built their own plant, they manufacture themselves. They've tried to take out all the costs they could possibly take out. Now, it probably could be losing money. But, how much can they lose on that, right? And so Jim Sinegal said, that's a sacred cow. We are not going to change the price on that, right? And the members appreciate it. In fact, Costco raises its membership fee every 5 years. The last time they didn't raise it for like 7 years. They didn't need to do that. But they said, we're making enough money. We don't need to do this, And so I just think that on so many levels, and I think it's that kind of a business, a large extent because Charlie was on the board. I think Charlie wouldn't even say it to me, but he improved that business. And they wouldn't even have realized that he's improving it. He's not an activist, but he would have given them these small suggestions here and there, and over time that just kind of cascades on itself.
Yeah, what's his style? Because you knew him. And when you know somebody, it's very different than reading about somebody or hearing about somebody or hearing what they say publicly. You pick up more just observing somebody in their day-to-day interactions. Was he very blunt in his suggestions? Was he very good at getting people to think it's their idea? What was his style in terms of influence?
Yeah, I think Charlie comes across as having a kind of a lot of rough edges, if you will, a very blunt person. But I think what I was surprised both with Warren and Charlie is they have very warm and tender hearts. It's actually beautiful people when you get past the exterior. To some extent, to protect themselves, they have this kind of exterior. But if you get into kind of the inner circle where you can get past that, it's a wonderful person. Now, at the same time, he called a spade, right? But I think that when they're interacting with CEOs or interacting with people who are running businesses for them, they understand really well that the person needs to have the freedom to build the sandcastle they want to build. And they give them that freedom, right? And they don't second guess when they think they're making a mistake, etc. But if they are asked for different inputs, they'll, in a very kind of careful way, give you the kind of path that they might want to go down,
right,
and take it from there. So actually, the managers are very motivated because they're very empowered. They don't feel that someone's looking over their shoulders, and to a large extent, the managers do well because they don't want to let these guys down.
Tell me about the difference between risk and uncertainty.
Yeah, well, that's an important concept to understand because Wall Street gets confused between the two. And in fact, when Wall Street gets confused between the two is where the greatest opportunities lie. Okay, so we talked about Frontline. Frontline was an example of a situation where uncertainty was extremely high and risk was very low, right? What Wall Street is looking for is certainty. Okay, so if we look at a company like ADP, they process payroll, right? I don't know, they've had some like 50 years of non-stop growth because, your payroll, you're running payrolls is going to keep going up. Your cash flow is going to go up. It's all in a straight line. That's beautiful. And Wall Street will reward you extremely well for that. Whereas if you look at a company like Frontline,
and it's priced accurately,
it'll be priced for euphoria. It'll be overpriced. Okay. Because they love that. That's what they're looking for. On the other hand,
that's their type.
Yeah, that's music to the ears. On the other hand, if a company exhibits high uncertainty, it will be taken out back and shot, right? And those are where the opportunity lies. So one of the cues to look for, is this a business with low risk and high uncertainty? So when you run into these companies, you're looking at, looking at Value Investors Club, etc. It's something to keep at the back of your mind is this a high uncertainty business? And is this a low risk business? The combination of the two. And when you get to the combination of the two, low risk plus high uncertainty equals high rewards. So usually you're going to be, that's a deep vein to look into.
I was looking at your portfolio and you have this company you invested in Turkey that's like a Coke bottling company. Would you say that's a good example of kind of the risk and uncertainty mismatch? Or how would you describe that one? Because once I heard the story, I thought, man, that makes a lot of sense. That clicks. What was the clue that sort of tipped you off, or what concept would that one fall under?
We actually made money on it, but we exited.
Okay.
And the reason I exited is that the Coke bottler basically had a parent company, which was the dominant beer bottler in Turkey and several other countries. Their largest operations were in Russia, where they have number one market share, 50-50 joint venture with InBev. And Russia has effectively nationalized that business.
I see.
And I think they did it because they were somewhat upset with Erdogan about something. So they went and did that, about his support for Ukraine or something. And when that happened, it went in the too hard pile for us. I couldn't actually
explain the too hard pile. That's something I stole from you.
Yeah,
last time.
It's a Warren thing. We'll get to that in a second. But basically, it was something I couldn't handicap. So we were sitting at a gain, and we have this event take place. I get to get my bet back with some added return, and we close it. I said, where do I sign?
Right.
Right? I can go find something else to play with. But the too hard pile is actually a physical box on Warren's desk. Okay. And so actually, if you Google it, if you just Google Warren Buffett, too hard and whatever, and look for images, that image will probably pop up. Okay. So he has a box on his desk, which he calls too hard. And he says that 99% or more of investment ideas that you encounter should go into that box, because we're not going to be able to figure it out. So one of the things to understand is that if there's 50,000 stocks in the world, we are not really going to understand more than a few hundred of them at the most, after quite a while of studying them. So most companies that we would encounter should go into that box. Okay, so one of the important things in investing is humility. Humility to understand. I mean, Warren has no issues with the humility to know that he doesn't know most things, right? That most things are not going to be able to be figured out or handicapped or any of that. And we don't need to. If you can understand a very small sliver of things, and you know when those things get overpriced and underpriced, that's all you need.
Right.
You don't need anything else.
There's a guy who owns a bunch of real estate, but like in a very small area.
Yeah, that's
right?
John Arrillaga.
Yeah, what's his story? Because it sounds like it's a good example of this. A very thin kind of circle of competence, but he knew the pricing and was able to.
So John Arrillaga was a billionaire. He passed away maybe like 2-3 years ago, pretty recent. And his daughter's married to Mark Andreessen.
That's right, yeah.
So it's billionaire to the power of billionaire. Okay. So anyway, John Arrillaga basically had a very narrow circle of competence. He didn't understand most things, but he only invested in real estate within 2 miles of the Stanford campus. Okay, that's all. Usually just right around the campus. And if you walked with him around the campus, every single building, he could tell you the full history of the building. When it was built, what the current value was, what the rents were, who the owners were, and what the history was.
Right.
He knew that about every building. And what he did was...
That's incredible.
Oh, yeah. But, so he was an inch wide and a mile deep. And that is a really good trait for an investor, is to be very narrowly focused.
Right.
Right. Now, what John Arrillaga did is he ran, generally speaking, a very under-levered portfolio. His portfolio always not much debt. When the downturns came, he aggressively bought up, because all these distressed properties around, I mean, this is the most prime real estate you can think of, other than Park Avenue or something. Okay. And so he would just buy these things up when everyone was getting foreclosed and bankrupt, and go to the banks and buy it from them and all of that. And then, get them all leased and fair value and all of that. Again, take the leverage down, and again, next down cycle, again, the same thing. And he stuck to that. So the thing is, he didn't wander into, let me go to Mountain View and do it.
Right.
Okay, or let me go to California and do it. He didn't do all that. I mean, he's basically, let me invest in tech or something. He didn't do any of that. He stuck to real estate. That's all he did. And he did it extremely well. And he died a billionaire. One of the important things about that story is we don't need to know many things about many things. We need to know a lot about a little. That's the important thing.
Right.
Know a lot about a little. Right. So like, for example, if I'm looking at Frontline, I should learn everything I can about shipping. I should learn everything I can about oil shipping, about tankers, about the history, who makes them, and every nuance about them. Right. The deeper I go, the better it's going to be for me.
Right.
Okay. I shouldn't be spending time next week on airplanes. Okay. Just leave it alone, like one by one by one.
Right.
And like I was talking the other day, the older gentleman, like 70 plus investor, really good investor. And he was telling me, he's had an investment for a long time in this aircraft leasing company called AirCap. That's a very good business. And again, if you spend time in that industry and business, you would understand the nuances and kind of take it from there. But it's very important to be willing to go deep. And that's why the Value Investors Club, that can get you going. You can read the annual reports and the history and just keep going deeper.
Right. Why do you think most people don't do that? Because when I hear that, I think, there's a blueprint. You're not going to do exactly what he did. That was a one play. But the blueprint of, he was smart enough to intuit like, hey, I think this area in California near Stanford is going to be a good area for me to be in.
Yeah.
So generally, I pick a good wave, and then not over lever.
Yeah.
Only take leverage when, basically when everybody's fearful, get greedy. When everybody's greedy, be fearful. So he did that. And to just say, I'm going to go deep, and in this 2-mile radius, I need to become super knowledgeable, and I don't need to get distracted by everything else, and I'll hold forever. Right?
Well,
Like
if
that's a
you
blueprint.
Think about it. I think it was Nick Sleep who has this quote. He said, the best investors are entrepreneurs who never sold. So if you think about entrepreneurs, that's what they are. They are John Arrillaga, right? So if I look at Sam Walton is John Arrillaga. All he did was retail. All he did was visit competitor stores. He never bothered with anything else.
So
right?
Sam Walton, founder of Walmart.
Yeah. I mean,
what do you mean? Tell me more about him.
So Sam Walton, he said that there is no human who has ever lived or ever will live who has spent more time in competitor stores than me. Okay. Whenever he'd go on vacation with his family and they were passing a retail store, he said, I'll be back in 20 minutes. And he'd go.
And what is he doing in there? What did he do?
So I'll give you an example. So even with his managers, because he would like to visit all his stores and all that, but if he'd see a competitor store, sometime he'd go in with 3 or 4 of his managers. One time he went into the store and his manager says to him, that was such a badly run operation. And Sam says to him, yes, but did you see the candle display? Did you see how fantastic that candle display was? So his perspective was, I can learn from losers. Okay, I want to learn the spark that's there in something that's a total loser, right? So he was going in. Now, one time in Brazil, in this retail store, they find this older guy flat on the ground. They call the paramedics. It turns out it's Sam Walton. And what he was doing is he was measuring the space between the aisles, and he didn't have a tape measure.
With his body.
So he laid down. And the space between the aisles is a very important data point for a retailer, because you're going to either waste square footage or be too narrow and the people want to enjoy the experience. So you have to get that right? And so he was in Brazil saying, how are they doing it? Am I 3 inches too wide in Walmart? Am I 3 inches too narrow? What's going on here, right? So this was a game of inches. That's who Sam Walton was. And in fact, Walmart has not innovated at all. At least for the first 20, 25 years that Walmart ran, everything came from somebody else who was already a competitor. They took a lot from Sears, they took a lot from Kmart, and then they killed them.
Right.
Okay. And they kept learning from one competitor after another. So Sam Walton actually used to say, I'm not the smartest tool in the toolbox. I'm not a smart guy, but I'm a learning machine. I'm going to keep at this. And what others have become. So, it's very funny. He goes and visits Soul Price, the founder of Price Club, which eventually leads to Costco, right? And he looks at Price Club and he says, this is fantastic. And he creates Sam's Club, right? And Costco was also taken from Price Club. So both Sam's Club and Costco, they would not have existed.
So Sam's Club is Sam Walton. I
Oh
didn't-
yeah,
I didn't even know that.
it's part of Walmart.
Oh, I didn't even know that.
Oh yeah, it's part of Walmart, and it was completely cloned from Price Club, which was a predecessor to Costco, right? So Sol Price, who was an incredible entrepreneur, someone goes to him and says, no one has had more impact on retailing than Sol Price, because Sol Price influenced Sam Walton in a major way, and he influenced Jim Sinegal, the founder of Costco, in a major way. I mean, these are the pillars, and then these two companies influenced Amazon. Right? So it's all coming from Sol Price. So someone told Sol Price, you are like the father of retailing in the US and actually globally. What do you think of that? He said, I wish I'd worn a condom.
That's too good. That's amazing.
Yeah, and the thing is, it's amazing. He was, in fact, it's actually in his son's book.
So good.
Yeah.
So Sam Walton is...
Yeah, but I just want to say that, this book, this is a very good book. And it's out of print and it's hard to find. But I think that it's one of the best books on retailing. And so, for example, some of the things that Costco does, Costco pays 50% more than Walmart pays its employees. So the entry-level people are making 50% more. Okay, hasn't hurt their profitability. In fact, Sol Price's view was similar to Henry Ford's view, that I want the people who work in my stores to be able to shop in my stores. Just like Henry Ford said, I want my workers to be able to buy my cars. At that time, automobiles were for the rich. And Henry Ford said, no, I want them for everyone, right? So he wanted to drop the price. So I think at Costco, the lowest wage is like $20 an hour, like when you're starting out, whatever. And then they have tuition reimbursement, all kinds of other things. And they get a lot of productivity out of their people because of that.
You've got these books here and we're at your house. We're in your library. You've got, how many books do you think you have in here? This is 1,000 books?
A few thousand.
A few thousand books. Just to set the scene, so that your office, your computer's over there.
Yeah.
We're surrounded by a cave of books on every topic. So I see some business books over here. I see investing books. You just brought a book about Sol Price, the founder of Price Club, from over there. There's science, I think, on that wall. What does this door go to? What is this?
That's
like
my bedroom.
That's a bedroom. Okay, so you live in the library essentially, and you nap every day. I think
absolutely.
Yeah. So we're both nappers.
Napping is a great
massively underrated.
Yes.
What's your case for napping? I have mine. What's your case for napping?
Well, I just get tired in the afternoon, whatever.
It's very simple. Okay.
I've been so used to napping that if I don't nap, my productivity goes down, and so I actually don't like to work if I'm not productive. And what I find is that even if I, lay down for half an hour, 45 minutes, I'm re-energized.
Right.
And I think for the work I do, I need to be all in. Yeah. So I actually can't do this work if I'm tired.
Yeah. There's this athlete, Conor McGregor, and they asked him about his training schedule. And he said, one of the big mistakes I made is that I was always trying to train all the time. I wanted to come to the gym 3 times, 4 times a day. I thought that's how you win. And his coach was basically like, you're like a light that's always just dimly flickering because you never turn off, and therefore you can never turn on and be as bright and as effective as you could be.
Yeah.
And this flickering dim light, it's not doing you any justice. And so I've used that in my own model of like, where's my light right now? And if I need to just shut it down briefly, 30 minutes, an hour, whatever it is, to come back full brightness, that's the move.
Jeff Bezos, he said all decisions, important decisions, in the morning. And he's very particular. He needs a solid 8 hours at night. Right. And he leaves work at a normal time, right? But he says that they don't do the important decisions in the afternoon. Right. It's the first thing in the morning because he wants the highest energy levels. And in fact, what I also try, I find my best work is in the morning.
I'm curious about your style because I came over to your house once and you're very calm. You weren't like, it didn't seem like you were on the clock. You're moving from one meeting to the next. There was not a big bustling team of analysts and junior people. It didn't seem, you seem like you keep a pretty clear calendar. Is that intentional? Do you think is that just what you like or is that effective?
Well, in the business I'm in, if I can find a couple of things to buy in a year, in the case of Buffett, one thing to buy every 5 years, right? I'm doing well. And so this is not a situation where having some packed schedule or whatever. I think the thing is that this is a case where you're taking in a lot of information, but there's not much action, right? And so you're basically trying to improve your mental models. You're trying to understand more about the businesses that you already own. And I'm going through Value Investors Club and Sum Zero and that sort of thing, and just looking at what else is there. And sometimes I find amazing idea, whatever, and then there's a deep dive. Right. And then that might take a while.
I was reading something interesting. So in our first episode, we talked about how you got started. You were actually an entrepreneur first. And then basically, you said this great thing. You go, I realized that as an entrepreneur, maybe 3 to 5% of my brain power was on strategic decisions, really clear thinking, coming up with the right answer. And then 95% of my time was blocking and tackling. And you're like, as an investor, it's great because that 3% becomes 95%. It's just about clear thinking and making the right strategic move and not, I don't have to busy myself. But one thing I thought was cool was I read that you took some personality test or you got some analysis done on you that basically helped you, they sort of told you your temperament is for single player games. What is this? I didn't understand what you did.
Yeah. So this was kind of accidental that happened. And I think it turned out to be one of those great things that happened in my life is that in 1999, actually, I was at a crossroads where it was very clear to me that the business that I had built, my IT business, I had lost interest in it. And I had become a lot more interested in investing. And it was a difficult time because I had 170 people in the company who thought I'm motivated and I can't fake it.
Right.
So very accidentally, I was with these 2 industrial psychologists and they basically did 360 on me. So they had me take a bunch of tests. They talked to my direct reports. They talked to my friends, family, spouse, so on. And they built a kind of 360 view of who I was. And then they gave me what I call my owner's manual. And I think everyone should have their owner's manual.
Like it comes with an appliance you bought.
Yeah. I mean, it's we show up, we don't have an owner's manual. And each one of us is programmed differently. So what they said is, look, the way a human is, his traits, likes, dislikes, and what passions they are, that is hard-coded at the age of 5. And that is not going to change from the age of 5 to the age of 95. Okay? You might try to, so you cannot change traits. You can try to change behaviors, but you cannot change traits. Traits are between your genetics and the first 5 years of life, hard-coded. So the good news is, and we see this, right? So once we figure a person out, like we get to know someone, after 20 years also, they haven't changed, right? And in fact, the people I went to high school with, this was all pre-Facebook, right? And I lost touch with all of them. I mean, they were in India and Middle East and wherever, right? And then Facebook shows up, right? And now they're in their 40s and 50s, right? And I haven't had any interaction with them for 20, 25 years. No change. The guy at 18 and 48 is the same guy, right? Because the traits are so hard-coded. So that makes it easy for us because once we figure a person out, we don't have to figure them out again. It's one and done. So what they said is that now the problem most humans have, which I had, is we don't know what those traits are. What most of us try to do is we do what they call mirroring. We look at what the world considers acceptable and we adapt our behaviors so that we kind of fit in. But that can be a big disservice. Okay, so basically what they were able to tell me is they said, look, you are a person. They said, when we look at the company you're running and we look at who you are, we don't even know how you can go to work.
How you're functioning.
Yeah, we don't know. And actually, I was in pain.
Oh.
I was in a lot of pain. And the thing was that I loved that business when it was just me. And I loved the business as it was growing until we got to the first 10, 15 people. And then as I started growing beyond that, my life became, and my job description became HR. I'm just herding cats. I'm not a cat herder. Okay, that's not who I am. Okay, so what they said is that business that you have, you need to get rid of it in some way as soon as you can. And I was just thinking at that time, this was in March or April of 1999, I was just thinking of starting Pabrai funds, right? They looked at it and they said, this is perfect for you. This is going to work extremely well for you. In fact, one of them invested. He's one of the first investors who came in.
He was so, and he put a skin in the game. He was like,
I told him, listen, I'm paying you guys $2,000 to do this. You're giving me $100,000. I really don't want to lose your money. They said, I don't have any doubts, Mohnish. You're going to do very well. So I don't see any risk here, right? And he did extremely well. And so they were actually right, because now it's been 26 years since I've been running it. And I haven't gotten bored.
So what did your owner's manual say? So I said, don't like that. What did
my owner's manual basically said that, well, first of all, they said that I had very high horsepower, right? And they said that I was one of the smartest guys they had come across, etc., which was great. But they said that you are a guy who likes to play single player games. You are not the kind of guy who would be happy being in a soccer team, for example, where you're one of the forwards or whatever, and your performance depends on the team. They say you seek out games which are single player games where you think you have some edge. And when you think you have some edge and it's that sort of game, you will kill it. And actually what I've noticed is, like, so for example, I got banned in Vegas playing blackjack, right? Because
okay. I got to know this story.
I figured out a system which basically beat them. Okay.
Counting cards? What were you doing?
And actually did it without counting cards, right? And in fact, it took the casino almost a year of watching me. So I used to go every like 6 weeks or something, and they played those tapes over and over because the markers that they look for were not there. But we'll talk about that in a second. Okay. So what I'm saying is that, so what are the games I like? I like blackjack. I like bridge. I like investing. And even Dakshana, for example, the Dakshana Foundation, that's also a game, right? These are...
That's your philanthropy.
Yeah, but they're all mathematical games. Even Dakshana is a mathematical game because what I'm looking at is input-output ratios. People think I'm doing all this good in the world and all that. What they don't understand is I'm a game player, okay? And what I'm trying to do with Dakshana is how much money is going in and what's coming out. Right. And that's the only thing I'm focused on, is what's going on. What ended up happening with the entity like Dakshana is, Warren Buffett wrote me a letter saying that this is the best. Right. I mean, like, he took the time to write the letter like, this is the best. Okay. Never done that for any philanthropy that he's looked at. Well, he did that because actually there is no nonprofit I know of that does it better than Dakshana. And the reason is because there's a game player who's not focused on, name and lights or a bunch of fancy pictures in the annual report. We have no pictures in the annual report. It's just like the Berkshire report, right? But it's about an honest input to output, singular. So what I did is every year that we ran Dakshana.
Well, explain what it is. I don't even know.
I will, but I'm just saying that our focus has been this year needs to be better than last year. Right? It's the same as the way Sam Walton ran Walmart. He wants next year to be better than this year. So if you take a step back and say, okay, I want to give money away to make the world a better place. So the natural second step you would get to with that is, I want very high returns on the money I'm putting out, right? So social return on invested capital should be extremely high. Now, most nonprofits don't even think this way. They're all heart. There's a homeless guy, let me help the guy, right? They don't really do an analysis of, okay, what is going in and what is coming out. So I ran into this model this guy was running I think in 2006, I ran into it, where he was taking 30 kids who were very, very poor in India, in Bihar. And most of these kids were coming from illiterate parents, etc., but they have very high IQs. And he prepped them for about 10 months. And he had them take the IIT entrance exam. The IITs are they're the best technical institutes in the world. And now the thing about the IITs is that there's about 1.3 million kids applying for 16,000 seats. It's about a 1.3% admit rate. Okay. Princeton is about a 5% admit rate. Harvard is about 5 or 6%. This is 1.3%. And if you get into the IITs, it's basically free to attend. The government subsidizes it. So if you're a very poor person and you get into the IITs, well, now Microsoft will hire you, Google will hire you, anyone will hire you, right? But getting in is expensive because the coaching is expensive. So what this guy had done is he had made the coaching free for these very poor kids. And now what was happening is you had a family that was making $60 a month, let's say, and the kid graduates and Google hires him for $120,000 a year. Okay. I mean, the transformation, and in 5 years, the guy's making $300,000 a year, right? And so and he was spending $800 per kid.
And the training, the
whole prep. So you spend $800 and you take a family from $60 a month to $10,000 a month. Okay, I mean, what's the ROI on that? And you're going to do that for this whole lifetime, and you're going to reset the extended family and all of that. The ROI is off the charts, right? So when I saw that, I said, wow, this is the holy grail. So I went to the guy and I said, I'd like to fund you, right? He said, I don't want to scale. I do 30 kids. I don't want even 31 kids. I don't want to take outside money, none of that. So I'm the shameless cloner. So I told him, do you mind if I clone your model? He said, no, this is a very good thing. I think you should clone it. It'd be great. I'll help you in any way I can. So I took his model, and that's what Dakshana is. He was doing 30 kids a year. We are now doing 1,000 kids a year, right? So we are doing it at scale, and it'll be about 2,500 kids in a few years. And he was doing it at $800 a kid because his mom was cooking for them. Okay. I have chefs cooking for these guys. I'm at $3,000 a kid. Okay, because we have like much better infrastructure and all of that. But it doesn't matter. The 3,000, you're taking a $60, $80, $100 a year type family, a month family, and you're making them part of the global economy, hired by Microsoft and whoever else, right? So it's zero to hero. And so the ROI on that is hard to measure. So Dakshana spends about $3 or $4 million a year. Just imagine what the output of that is. When you look at it from each family, and we're doing 3-4 million, we've been doing it for 17 years. So basically, what we get out of $3 million a year, a lot of other nonprofits would not get out of even $100 million a year. So we actually, have a footprint that is much larger than what it should be in terms of impact. But to take it back, it's a math game. So basically, we had 2 or 3 things that were important, and that's how I looked at this. The first was the yield. So the IITs accept 1.3% of the kids who apply. They accept 70% of our kids. Okay? Now that number, 70%, in the first year we started, was 8%.
Okay.
And we had a lot of fuck-ups in how we were doing things then, right? All I said is, I'm at 8%. It's going to be more than 8% next year.
Right.
And I know what the issues are. I'm going to fix those issues. We went up to like 15, 20%, right? And then every year we looked at what was happening, how could we tweak it, how could we reduce our costs or increase that, and all of that. And we kept chugging at it. And we've been chugging at it now for like 17 years. So it's just like Walmart or anything else, or Amazon, any of those companies where basically you want excellence, and excellence not going to come in a day, but you just keep going every day.
That's amazing. I love that model, and I love how you basically took the skill set from A and applied it to B. So
now what I'm doing is I have a game which puts 2 models together. So one day before I die, I want to have $10,000 left. Okay, so basically inheritances just don't do much, right? I mean, my kids already they're doing well.
Yeah, what is your philosophy on that?
Well, in general, large inheritances are going to do more harm than good. And, basically, you don't want a person to be on an IV drip for their whole life. I mean, that's just the worst thing you can do to someone. And so Buffett has a great quote. He says, I want to give my kids enough money for them to do anything they want, but not enough to do nothing. Okay. Okay. So because I am investing for a living and we have this kind of compounding going, I'm going to end up with more than I need. I mean, basically, I don't need to spend any more than I'm spending. I could not increase happiness by spending more. So there's no point to spending more. I mean, I'm very happy with the lifestyle and everything else, right? So Everything else basically needs to get recycled, but it needs to get recycled at high returns. So on one hand, I have a compounding engine and a net worth that's growing. On the other hand, I have to give it away. So God Google told me that on June 11th, 2054, I'll be leaving planet Earth. Okay. So
you asked AI, what did you do?
if you
average life expectancy.
If you go to God Google and just say, hey, I'm 52 years old and tell me when I'm going to die, he will tell you. Okay. And now that we have the date, so my birthday is June 12th. Just to make it poetic, I made it June 11th.
Okay.
Okay. So we have an exact number. So basically 2054 means I've got like 29 years and change left, right? And at any kind of compounding rate, it's a ridiculous amount of, assets that get built over the time. But I want to end on June 10th with $10,000. Okay. So there's one game which is to give it away. The other game is to make it. And we need the two curves to be where the giving away becomes probably in the next few years needs to become very much more dominant. So like the 3 million a year needs to go to 5, 10, 15 eventually and so on. And so for me, it's the same as playing blackjack. It's just a math game. These are both math games, right? And yeah, there are a lot of families getting helped. And my investors are happy. And so then that's fine.
Okay, so what was your blackjack system? I'm skeptical.
So the blackjack system, I don't want to, it would destroy the casino. I don't want to destroy the casino. I mean, they would have to either change the game or something. But basically, I'll give you some pointers of kind of what's going on here. There's a publication called BJ21, bj21.com. Okay, if you go to bj21.com, and you give them $100, they're going to give you a PDF, and I think for $100 you get like a 1-year subscription. They kind of update it every month. It gives you the odds of every blackjack table in North America. Okay. So for example, if I go to the Wynn Las Vegas, right? The Wynn Las Vegas has a bunch of different blackjack games, single deck, double deck, 6 decks, whatever else. Every single one of those, it gives you the odds if you play perfect blackjack. Now, normally, and these odds vary depending on how competitive. So if I'm going to some, riverboat in Indiana, I'm not going to get the same odds as Vegas. Vegas Strip is going to be more efficient because it's more competitive. So usually the house will end up with something like 0.3, 0.4%, all the way to like 2% edge over the bettor, which means every bet you're making, if you make a $100 bet, every bet you're making, you're losing like 50 cents or whatever and such. So there's a casino in Vegas called the El Cortez. And the El Cortez is a small casino. It was actually started by Bugsy Siegel, who made the Flamingo before World War II. And the El Cortez it's in downtown, not on the Strip, but it's a little away from the action of downtown. So in order to kind of induce people to come, they kind of improve the odds. Okay, still in their favor, but the single deck game at the El Cortez has the thinnest house edge of any blackjack table on the planet. The house edge is 0.18%. Okay. So if you look at that BJ21, if you look at all of they have the edges of every table. This one is the lowest, right? So this is a very thin, and I have a system where basically what threw them off, which took them a long time to figure out, is that they play single deck blackjack, right? But they only deal half the deck.
Right, and they shuffle.
So the reason they deal half the deck is so they can just make it difficult for the counters. Because you may be counting cards, the deck becomes very favorable, but then they shuffle. Right. So high cards at the back, but they never get dealt.
Right.
So the counters get screwed. Right. I had a system where it basically relied on the fact that blackjack occasionally has streaks. It has streaks where you may win 6 or 7 or 8 hands in a row, or you may lose 6, 7 or 8 hands in a row. And what I did in the betting was that usually when I was losing, it was always the minimum bet. And when I was winning, the bets were increasing. So with the variance of that, what happened is I was able to overcome
the 0.18.
0.18.
Right.
Right. So I don't want to give more than that.
Sure.
That gives it enough.
Okay.
Enough to get going.
I've tried to martingale the system.
Martingale, you're going to go bankrupt.
No, but I guess what I'm saying is you basically use the combination of the deck and the preset edge, and then basically how do you use your betting as the other variable?
Yes.
In order to
And what I'm going to do is when the cameras turn off, I'll explain it to you.
Okay, great.
So when you go to the next time, when you go to the Cortez, but now what happens is, so what happened with them, what really confused them, which they had never dealt with before, is normally what the counters do is on a brand new shoe, it's a low bet.
Minimum bet, yeah.
In my case, there was a brand new shoe, there's a high bet. So they said, we just shuffled.
Right.
The whole deck is there. There's no odds edge he has on that deck because the entire deck is there.
Right.
He has a high bet.
Did they ever figure it out, or did
they figured it out?
Okay.
It took them. So what they said is, they said, this is what they figured out. This is what they came. So what happened is, I'm playing blackjack. The general manager, who's very friendly to me, comes and sits down next to me and tells the dealer, stop dealing. Okay. So she's in the middle of a hand. She just continued dealing. He screams at her, stop dealing now. She'd never heard that before. Okay. Like literally middle of the day. She said, shuffle.
Right.
We're done. We're not dealing anymore. Then he tells me that, Mr. Pabrai, I like you. Okay. I read your book. I watch your videos. And you have a system that we cannot beat.
Right.
So I said, I told him, I said, I'm not counting cards. He said, that's what threw us off. He said, we know you're not counting cards and we know you'll beat us. And so you can come to this casino anytime you want, but you cannot sit down at a blackjack table. Then I'm thinking, why would I come here? Okay, why would I come to the El Cortez if I'm not going to play blackjack? But, whenever I go someplace to talk or something and, they're introducing me, I always tell them, listen, just say that I have a lifetime ban in Vegas.
Yeah, I mean, street cred through the roof.
I really don't care about everything else on my CV. That's really irrelevant. Yeah. And that's what's relevant.
It's just like if you get into Harvard, wow, that's impressive.
Yeah.
You're a Harvard dropout. That's the higher status signal. And so you're good at blackjack, made money in blackjack. I was banned from a casino. That is the highest status.
Yeah. So I took them for like about 150,000 or something. And this was a very low table limit.
Right.
The table limit was only 2,000. But at 2,000, I took them. So they said, okay, we're done.
I love it. I'll throw out some names.
Yeah.
And you could say pass, like I don't know them.
Yeah.
Or I have a story about them.
Sure.
Your stories are amazing. I could listen to your stories all day. So Michael Burry. One of my favorite movies is The Big Short, and Michael Burry is this kind of mysterious character. Did you ever meet Michael Burry?
What you're going to end up when we finish this conversation is you're going to know that my middle name is Forrest Gump. Okay? That's really where we're going to end up. So, I always tell people that God loves me. He loves me more than other people. And I'll explain why, right? In 2008, okay, so the financial crisis is not yet happened. It's like March or April of 2008, right? So things are getting topsy-turvy, right? And I was visiting San Jose for something. I was going to San Jose. And I knew Michael Burry had an office in San Jose. And I didn't know him, but I sent my email saying, Mr. Burry, I like you, admire you, etc., and would love to visit you.
So he was kind of well known?
He was not very well known, but he was like posting on Value Investors Club and things like that. He was there a little bit. And I liked the way he thought, And he said, oh yeah, stop by. Okay. So I go to his office in San Jose and there's a few kind of analysts sitting outside. It's a very seems like a very depressing place. Okay. It's kind of a little dark and there's a few analysts there. And then I go into the office and there's huge piles of paper everywhere. And he immediately launches into CDSs. Okay. And he says, look, Mohnish, I want to tell you something about something that's going to make you extremely wealthy. Okay. He then downloads to me at 1 million miles an hour. I've never heard of a CDS. Okay. And he's talking about housing crash and the coming implosion and all this stuff, and housing's never crashed. Okay. In the US, none of that. And 80%, 90% of what he said went straight over my head. Okay. Like he just gave me a full core dump in half an hour. My subhuman intelligence couldn't handle it. Okay, I couldn't. And, so I come out of the meeting, my head is spinning. And I say, okay, well, that was interesting. Okay. And then, of course, he rides off into the sunset, right? And then the movie comes out, right? And then he's exactly like they show in the movie, right? That's how he is, right? And I felt like, okay, God, who loves me so much, takes me to the epicenter of what would have been the best place to be.
Right.
The best teacher to have. And the idiot Mohnish blew it. Okay. But that's the way it is,
That's, I mean, where does that rank in terms of like, sort of the best calls or foresight in terms of that you've seen in your career?
I think this has happened to me a lot. I mean, in the sense that, like I said, we put 98, 99% a too hard pile, right? Even now, I think it was right of me to not do anything with it because I couldn't understand it.
Right.
Even after the financial crisis, it took me a while to understand the CDSs.
Right.
And all these tranches and how they were like doing all this stuff and all that. I mean, that took me a while to like really get my arms around it. And even after knowing all that, I would have been skeptical about making that bet. So hats off to him.
Right.
I mean, he figured it out. A few people figured it out, but it was a very small number of people who figured it out.
Tell me about the greatest investor from India. Who is the greatest investor from India?
Well, the greatest investor from India would be Rakesh Jhunjhunwala. Yeah. And I never met Rakesh. I mean, I know his friends quite well. Guy actually met him. Guy actually went to his office and met him. Wonderful guy, died relatively young, a few years back. But Rakesh was a very interesting kind of split brain in the sense that he'd have like 3 or 4 Bloomberg screens in front of him and he had all these charts and everything going on, rapid fire trading going on. But on the other hand, he had these 2 or 3 stocks that he never touched. So he had, I don't know anyone like that and he was great at both, but the ones that he never touched, I mean, they just went through the roof. Like there's a company in India called Titan Industries, and Titan Industries basically does branded jewelry. Branded jewelry basically didn't exist in India. It was all mom and pop.
Yeah.
And there was a trust deficit, right? So you go to a jeweler in India, and in India they have like 22 karat gold, right? And you're buying the gold. You don't know whether it's half gold, 80% gold, what the hell is going on, right? The jeweler knows, but you don't, right? That Titan brand is owned by the Tatas, who have very high integrity. So basically, they were able to take a sector which had a huge trust deficiency. I think Titan is still in its infancy. And I think Rakesh made a huge, Rakesh, I think, compounded at north of 40% a year for several decades. It's unbelievable. And, he started with like $10,000 borrowed, didn't even have that on his own. Someone lent him the money.
What made him great? Was he a brilliant mathematical mind? Was he, because what was the trait that really helped him?
I think so he was a trained CPA. India is equivalent of CPA, chartered accountant. So he obviously understood numbers well. But I think he was really smart about understanding business. And he was smart about understanding the few things that he thought would do extremely well. And just before he died, so he had figured out that Indigo, which is a low-cost carrier in India, they have like something like 70% market share, growing very rapidly. It might become the largest airline in the world. I mean, they've got like 1,000 planes on order or something. Okay, so they're growing very fast. He had done well as an investor in Indigo, but then he took the next step and he set up a clone of Indigo. I mean, just think about the guts you need to set up a bloody airline, okay, from being a passive investor. And while he was dying, he was like in bad shape, in hospital and all of that. And that airline's up and running and cranking and all of that and doing great. So if he had lived longer, I think he would have gone not just as an investor, but also shown that he could be an operator. And I was just in India just recently, last month, February, and I met one of the guys who worked for him. Just very impressive people, very down to earth, very impressive.
You said something like if he had lived longer, this idea of like runway and how early you start matters a ton.
Yes.
Even Buffett, I think you've said that had he not been giving away so much money along the way.
He'd be the wealthiest guy. Yeah.
He'd be the wealthiest guy in the world right now.
Yeah.
And, I guess when you when you go talk to people, are you just sort of like, you should have started 30 years ago. Is that the number one message?
Well, what we started our conversation with, right? I think the important thing is that if there's a young person listening, it's really important that they start. The funny thing is that if you look at the rules for an IRA or a Roth IRA, there's no minimum age. You could be 6 months old and have an IRA.
Right.
The only rule is that you can only put in wages that you earn. And I was just reading in the Wall Street Journal, there's some entrepreneur who's hired his kids who are like 4 years old and like 6 years old to do like different things in the business because he's putting like 6,000, 7,000 into their Roth IRAs,
right?
Which is equal to their W-2 earnings, right? And probably stretching the limits of what he can get away with the IRS. That's beautiful. But even if you're not doing that, if you start at 22, I mean, that's the important thing is that when you start earning at 22, a small amount saved at 22 is more important than a larger amount saved at 32. Right? Because you get started earlier.
Right.
So it's really important to have the whole spend less than you earn and put it into Berkshire, set it and forget it. Yeah, because then if you start at 22 and you're 22 today, you're going to live over 100.
Right.
You're going to go to 100, 110 by the time, because all the advances taking place. That's a 90-year runway. I mean, a 90-year runway is something. I mean, if you're talking about even a 10% return, we are only going to look at doubles, right? So every 7 years, that's 2 to the power of 13. 2 to the power of 10 is 1,000. That's 2,002. That's 8,000x. Okay, the first 10,000 you invested is at 8 million.
Right.
The second 10,000 is another 8 million. So the thing is, it's a mind-blowing amount of money if you start early. So the length of the runway is really important.
Do you pay attention to the macro? Because, my head starts to spin. It's interest rates, and then there's wars, and there's all these different factors that you could pay attention to. And there are some people who really pay attention to that. Do you pay attention to the macro?
No, because I can't handicap, and I wouldn't know what to do with the information. So I always try to keep the bet simple. I need to be able to explain to a 10-year-old in 5 sentences. I'm not going to be able to figure out the macro. That's why I couldn't make that CDS bet. It was like so much stuff going on about housing's going to crash, this is going to happen, that's going to happen. I mean, I just couldn't get my arms around it,
Do you think about, Buffett, I would say famously kind of missed a lot of the tech wave that happened in the last 30 years. Now I know he owns Apple and some other things, but largely like internet wasn't his zone of genius. Do you think about AI? In my world, everybody's talking about AI. Everybody's thinking about AI. You can't really make a move unless you sort of are factoring in AI. Do you think about AI at all?
The problem is I bring nothing to that party. And I'm probably going to get my head handed to me if I try to participate. So it's not in the no-brainer category. It's not something where I have an edge. Of course, I do believe that it's transformational. But I knew the internet was transformational. We've known electricity is transformational. We've known the app store is transformational. But in investing, you can do extremely well without understanding all these things. We go back to John Arrillaga, doesn't understand any of these things. Or even Warren Buffett. And Apple is in the rear view mirror. They sold most of it.
Yeah.
They might have sold all of it by now. But basically, that was a one and done. But basically, yeah, I think that we don't need to understand flavor of the day. We don't need to understand NVIDIA. We don't need to understand AI. If you understand it, more power to you. That's awesome. And if you know how to leverage that understanding into dollars you can make, that's even better. But that's not me. So we all have to play to our strengths.
Okay. Well, Mohnish, this has been incredible. Part 2, I'm happy with it. I asked you at the beginning, I said, is this like one of those Hollywood sequels where the first one was incredible and the second one, they just did it? But no, I think we did a good job. I think the sequel was, if not better, at least as good as the first one.
Well, you got some material you can cut and paste, do different things. So we'll see. No, it was fun. I enjoyed it. It was awesome.
Awesome. Thanks for doing it.
Okay. Thank you.